Usually when we talk about a medical diagnosis, there is this really comforting expectation of precision.
Right. It feels very scientific.
Exactly. It feels like engineering. Like
Yeah.
if you break your arm, you go to the hospital, they put you in an X-ray machine, and the doctor puts that black and white film up on the light board,
Yeah.
and they just point to a jagged white line and say, well, there it is. That is the problem.
It is incredibly binary. It's either broken or not broken.
Right. And as stressful as a broken arm is, the diagnosis itself is actually really comforting.
Oh, absolutely.
Because we are just wired as human beings to like things that are visible, categorizable, and, easily solved with a cast.
What a clear fix.
Yes. But then you step into the world of investing, specifically the stock market, and suddenly that beautiful, precise X-ray machine is just completely shattered.
It really is.
We are looking at a financial landscape that is, well, honestly, it is a murky psychological swamp.
That's a great way to put it.
And especially, and I think this is the craziest part, it gets murkiest when things are actually going incredibly well.
Oh, 100%.
So welcome to the deep dive. Today, we are exploring a universal feeling that I guarantee every single person listening who has ever invested a dollar, a euro, or a rupee has felt deep in their stomach.
I know have.
It is that bizarre emotional roller coaster of opening your brokerage app, seeing your stock portfolio turn this bright, glaring green, hitting all-time highs, and suddenly realizing you have absolutely no idea what to do next.
It really is the absolute definition of diagnostic muddy waters.
Yeah.
Because, when you are losing money in the market, the problem is obvious.
Yeah.
The screen is red, you feel pain, and the solution is either to cut your losses or just, wait it out.
Right. It's a very clear action plan.
Exactly. But when you are making money, especially a life-changing amount of it,
Yeah.
the human brain essentially short circuits.
It completely breaks down.
It does. The fear of losing the game entirely replaces the joy of actually making it. The X-ray doesn't work anymore because the broken thing isn't the market. It is our own psychological wiring.
Okay, let's unpack this feeling using an analogy we all know intimately from childhood.
Okay, let's hear it.
Think about playing a fiercely competitive game of Monopoly.
Oh, wow. Yeah, friendships end over Monopoly.
You really do. So you have been rolling the dice for 2 hours. You've been aggressively buying up properties. And finally, you have managed to put red hotels on Boardwalk and Park Place.
A dream scenario.
Right. You look at the board and it feels incredible. You feel like a certified real estate tycoon. You're rich.
On paper, anyway.
Exactly. That is the massive, glaring catch that investors forget. It is entirely 100% paper wealth.
Yeah, it's just cardboard and plastic.
Right, until another player actually rolls the dice, lands on your specific square, and physically hands you that colorful paper Monopoly money, you haven't actually realized any of that wealth.
That is so true.
Paper profits aren't real until you book them. Until you sell, they're just, pixels on a screen mocking you with what you could have.
The Monopoly board is a brilliant visualization of this. And that specific transition, the agonizing decision of when to convert that paper wealth into actual secure capital, is where the vast majority of retail investors make their most catastrophic mistakes.
Wealth-destroying mistakes.
Absolutely wealth-destroying.
Yeah.
They basically fall into one of two extremes.
Which are?
Well, they either panic, hit the sell button way too early just to secure a tiny win, and completely miss out on massive decade-long compounding.
Right.
Or they hold on blindly, paralyzed by greed. They ride the wave all the way up and then all the way back down through a crash, just watching those beautiful red hotels turn back into empty, worthless lots.
Man, that hurts just thinking about it. So our mission today is to rescue you from the anxiety of market highs. We are going to build a personalized, mathematically backed, bulletproof framework for you. We are going to explore the mechanics of exactly how to take money off the table without accidentally butchering your golden goose of compounding.
It's a delicate balance.
It really is. And we are not just guessing or giving you our personal opinions here. We have an incredible stack of sources today that we are going to synthesize.
The data we have is fantastic.
It is. We are pulling insights from fundamental wealth-building research by Funds India and Prime Investor. We've got tactical strategies from Angel One.
Which are really practical.
Very practical. Plus, mutual fund exit philosophies from E.T. Now and Shankar Nath. And finally, real-time, in the trenches, technical chart breakdowns from traders on TradingView and Zeroda's Varsity.
It is a remarkably comprehensive stack of data.
Yeah.
And, the most fascinating thread running through all these disparate sources is the consistency of the underlying message.
It all lines up.
It does. Whether you are looking at a 20-year mutual fund study spanning multiple recessions or a 15-minute technical chart on a random Tuesday, the mechanics of when and why to book profits rely on the exact same core principles.
Which all comes down to psychology, right?
Exactly. It all comes back to human behavior intersecting with market structure.
Before we get into the mathematical formulas, the asset allocation strategies, and the chart patterns, we have to start with the messy stuff. We have to address human emotion.
The hardest part.
Oh, for sure. Why do soaring markets make us so incredibly anxious? There is a story from the Varsity source that perfectly encapsulates this trap.
Ah, the OMC story.
Yes. It revolves around an investor dealing with a stock called OMC.
This specific case study is a masterclass in the psychology of the all-time high.
It really is.
It highlights everything that goes wrong when we let the flashing green lights dictate our behavior. Let's walk through the timeline because the macro environment matters just as much as the stock itself.
Okay, so the story starts in September of 2007.
Right before the massive global financial crisis.
Exactly. The investor buys OMC, and by sheer luck, incredible skill, or just being swept up in the pre-crash euphoria, they perfectly time the bottom.
Which never happens.
Right. But right after they buy it, the stock starts to rally. And not just a little bit. Over the ensuing months and years, they find themselves sitting on a massive notional profit in excess of 75%.
They're riding high.
They are. Fast forward to January 2nd, 2018. The market dynamics are shifting. A friend of theirs, who happens to be an experienced trader, looks at the broader market, looks at OMC, and strongly advises them to book those profits.
Good advice.
Very good advice. The friend literally says, take the money off the table, secure the win.
The friction in that moment is palpable. I mean, taking advice from a friend when you currently feel like a financial genius is incredibly difficult.
Oh, it's impossible. Your ego is huge. And they don't listen.
Of course not.
Driven by the greed induced by that massive historical rally, they decide to hold on. A 75% gain isn't enough anymore. They want 100%. They want 150%.
They get greedy.
Exactly. And then, as you would expect, when momentum fades in a volatile market, the stock begins to decline.
And it wasn't a slow decline.
No, it doesn't just take a healthy bip. The fall accelerates. Day by day, week by week, the selling pressure mounts.
Watching that happen is agonizing.
It's torture. Eventually, that incredible 75% notional gain, that beautiful paper wealth they were staring at on their app, completely evaporates.
Go on.
It blows right past their break-even point and turns into an actual realized loss of 10%.
To understand the sheer tragedy of that, we have to ask, what actually happened in that investor's brain between the 75% peak and the 10% loss?
Yeah, why do we do that?
Why do our brains completely malfunction during profit phases? It comes down to a fundamental shift in psychological framing.
How so?
Well, when you first buy an asset, your mindset is purely oriented toward growth. You are willingly taking a calculated risk to achieve a potential reward.
Right, you accept that it might go down.
Exactly. You accept the uncertainty. But once that reward materializes, once you see that massive 75% gain sitting in your account, your mindset violently shifts from growth to protection.
Oh, I see. You stop playing to win the championship and you start playing a desperately defensive game just to not lose the lead.
That is a perfect way to phrase it. The problem is that protection, if it is unmanaged, unstructured, and driven by emotion rather than math, quickly turns into hesitation and paranoia.
Which leads to terrible decisions.
Constantly. We see the psychological deterioration highlighted beautifully in the TradingView analysis regarding gold investments. The analyst points out a really common pattern.
What's the pattern?
When an investment multiplies, investors start watching the price action obsessively. Before the rally, they might have checked their portfolio once a month, maybe just when their statement arrived.
Sure, out of sight, out of mind.
Right. But now that they're up huge, they're checking the app 3, 4, 5 times a day.
Oh, I've been there. It's a sickness. You refresh the app just to get that little hit of dopamine from seeing the green number.
It makes you feel smart.
It does. It feels great. But then it dips by 1%.
And because the profits are now so large in absolute terms, a small percentage pullback feels utterly catastrophic.
The numbers get scary.
Exactly.
Yeah.
If your portfolio has grown to $1 million, a tiny 2% dip is $20,000 vanishing in an afternoon. That's a new car just gone.
That would make anyone panic.
And it does. The fear of giving back gains overrides all fundamental logic about the underlying asset.
Yeah.
You completely stop looking at the health of the business, the revenue growth, or the market share.
You just look at the colors.
You only look at the flashing red and green numbers. You are reacting to shadows.
Let me push back on this a little bit because I think a lot of people listening are probably having this exact thought.
Go for it.
It's a thought I've had many times myself. Isn't it completely natural and honestly quite prudent to just want to lock in a win?
It feels very prudent.
All right, let's say I buy a stock and I see my investment double. I put in $10,000 and now it is worth $20,000. Why shouldn't I just sell half?
The classic strategy.
Yeah, I take my initial $10,000 capital out, put it safely back in my checking account, and let the remaining $10,000 ride as free shares. That way, I literally cannot lose. I am playing with the casino's money.
The irony of that strategy is that the safety it provides is a complete and total illusion.
Really? An illusion?
Yes. It is what Shankarnath's ex-colleague, Saurabh, famously referred to as the free shares fallacy.
The free shares fallacy. Okay.
It sounds brilliantly safe on the surface. You recoup your capital, you eliminate your initial risk, and the rest is house money.
It feels like the ultimate investing life hack, like you sleep like a baby.
You might sleep well, but mathematically you're committing a profound error against your own future wealth.
Wow. Okay, let's break down the mechanics of why this is so damaging.
Let's do it. When you think in terms of arbitrary percentage gains like, I'm up 100%, so I will systematically sell half it, you are treating your portfolio like a literal casino where you take your chips off the roulette table after a lucky spin.
Which it isn't.
No. Long-term wealth building isn't a casino. It is a compounding engine. Thinking in terms of absolute percentage gains is a strategy that primarily benefits short-term momentum traders, not people trying to build generational wealth.
I am struggling to see why looking at a massive percentage gain is a trap, though. To me, and I think to most people, 100% gain is a massive, unmitigated success. You won the game.
It is a success, but 100% gain is often just the very beginning of a multi-decade compounding journey.
Just the beginning?
Yes. Let's look at the history of the market. Many of the top wealth-creating stocks deliver a 20% compound annual growth rate, or CAGR, over 20 or 25 years.
It's a huge rate of return.
It is. And if an asset is growing at 20% a year, the math dictates that it is doubling in price roughly every 3.5 to 4 years.
Okay, so if I execute my life hack and sell half of my position after that very first double,
Yes.
I have just permanently halved my exposure to the next 20 years of explosive compounding.
You have fundamentally severed your compounding base. You feel safe today because you got your initial $10,000 back, but you just paid hundreds of thousands of dollars in future opportunity costs for that temporary emotional comfort.
Oh, wow. That hurts to think about.
It does. And this leads us directly from the psychology of profit booking into the hard, cold, undeniable mathematics of it.
And this is where the Funds India study absolutely blew my mind. Because they didn't just theorize about this in an ivory tower. They ran the actual historical numbers over a massive, incredibly volatile 22-year period.
It's incredible data.
Let's look at it. They simulated an investor who put Rs 10 lakhs into the Nifty 50 Total Return Index in January of the year 2000.
Which is a fascinating, terrifying time to start.
Why is that?
That is right at the absolute peak of the dot-com bubble, right before a massive wealth-destroying global crash.
Right. It's the ultimate stress test for investment strategy.
Exactly.
And they tested multiple systematic profit-booking strategies against a simple, boring, do-nothing buy-and-hold strategy.
Right.
So in the profit-booking scenarios, the rules were strict. Whenever the portfolio hit a specific percentage gain, say a 20% gain, a 30% gain, or a 50% gain, the investor would skim that excess profit off the top and move it into a safe, low-yield debt fund.
They are essentially mechanizing exactly what human emotion tells us to do. Lock in the wins, protect the gains, don't let the market take it back.
Right, take the chips off the table.
So fast forward 22 years through the dot-com crash, the 2008 global financial crisis, the 2020 COVID dip, and all the bull runs in between.
A lot of chaos.
A ton of chaos. What were the results of constantly skimming those profits to feel safe?
It actually wasn't terrible. If you followed those protective profit-booking strategies from the year 2000 all the way to 2022, you would earn a very decent 10% annualized return.
Not at all.
No. You protected your downside during the crashes, you locked in your gains during the rallies, and you definitely made money. You probably feel pretty smart.
You would.
But the simple buy and hold strategy, The investor who did absolutely nothing, who just sat on their hands and watched their portfolio bleed during the crashes and soar during the rallies, outperformed all the active profit booking strategies by over 3% on an annualized basis.
People hear 3% and they think it's a rounding error.
It sounds tiny.
But a 3% annualized difference over 22 years is an astronomical divergence in absolute wealth.
It is staggering when you look at the final account balances. Over those 22 years, the buy and hold investor made nearly twice as much money as the investor who was constantly tinkering and skimming profits.
Double the money.
Twice as much total wealth, just for having the discipline to do absolutely nothing.
The middle school math behind why this happens is undeniable. It all comes down to the foundational formula for compound interest.
Which is?
A equals P times 1 plus R to the power of T.
Okay, let's take a second and actually walk through what those letters mean for the listener, because this is the engine of all wealth.
Gladly. A is your final amount, the ultimate wealth you end up with. P is your principal base, the actual amount of money you have working for you in the market.
The cash you put to work.
Exactly. R is your rate of return, and T is the time horizon. By constantly skimming profits, because you are afraid of losing them, you are systematically shrinking P.
You're making the foundation smaller.
You are continually, deliberately reducing your principal base. And because the broader equity markets, despite their terrifying short-term volatility, tend to go up over the long run, reducing that base interrupts the exponential snowballing power of compounding.
I was trying to visualize this while reading the source material, and it struck me like this.
Let's hear it.
Constantly booking profits based on percentage gains is like having an apple tree in your backyard that gives you a truly incredible harvest this year. And instead of just picking the apples, enjoying them, and letting the tree grow larger so its canopy can yield even more fruit next year, you get so excited by the harvest that you chop off half the branches and sell the wood.
Oh, wow.
You feel rich today because you sold the wood, but you have permanently crippled your harvest for the next decade.
That is the exact mechanism at play. You are trading future exponential growth for immediate linear comfort. As the Funds India research beautifully summarizes, compounding is free until you choose to pay for it by exiting.
That is a brilliant quote.
It really is. Let's look at some real-world, specific stock examples from the prime investor source to ground this math in reality. Take Kotak Mahindra Bank.
Okay, let's look at the timeline on that one.
On an adjusted price basis, the stock of Kotak Mahindra Bank went from about Rs 10 in January 2005 to over Rs 300 by December 2007.
Stop right there. That is a 30-fold gain in under 3 years. That is a 3,000% return.
Imagine holding that in your portfolio. The psychological urge to sell, to book that profit, to brag to your friends that you made a 3,000% return would be absolutely overwhelming.
I would have sold it 100%, let's be honest.
Most people would. If you used the percentage gain strategy or the free shares fallacy, you would have sold long, long ago. You'd have been dazzled by the 100% gain, or maybe you held out for the 500% gain.
Right.
And even if you miraculously held all the way to Rs 300 and cashed out, patting yourself on the back for your 30-fold win, you would have completely missed the actual wealth creation event.
Because what happened over the next decade?
Over the next 17 years, that stock didn't stop. It continued its compounding journey, eventually reaching levels of Rs 1900.
Oh, man. So you felt like a genius making Rs 290 per share, and by doing so, you willingly forfeited making Rs 1600 per share.
Exactly. Shankar Nath points to Titan as another classic, painful example of this phenomenon. It is a fundamental compounding machine that just doubles and doubles and doubles and doubles again.
Just relentless growth.
Right. If your hard-coded strategy is to sell when you hit 100% gain, you miss the second, third, and fourth multiples. You are structurally designing your portfolio to only capture the smallest possible fragment of a massive wealth creation cycle.
This is completely blowing my mind, but it also creates a massive contradiction that we have to resolve.
What's the contradiction?
Well, if buy and hold is mathematically superior and selling your winners just chops down your compounding tree, does that mean we literally never hit the sell button? Do we just buy stocks, delete the app, and take the passwords to our brokerage accounts to our graves? That can't be right either.
You are hitting on the crucial nuance. The rule's not, and never has been, never sell.
Okay.
The rule is that your selling strategy must align with your specific identity in the market. It entirely depends on who you are and what game you are playing.
That makes sense.
The Zero to Varsity framework does a phenomenal job of outlining this by breaking investors down into different market personas. You cannot borrow someone else's exit strategy if you're playing a different game than they are.
I love this framework because it forces you to look in the mirror before you look at your portfolio.
Exactly.
Let's walk through these 5 personas deeply because, listener, I guarantee you fall into at least one of these buckets, and knowing which one will completely change how you view your portfolio tomorrow. Let's start with persona number 1, the SIP investor.
The SIP, or Systematic Investment Plan investor.
Hmm.
This is the individual who essentially automates their wealth building.
Set it and forget it.
Exactly. They put a fixed amount of money, say $500 or RS 10,000, into mutual funds or broad index funds every single month completely, regardless of what the market is doing.
So what is their grand profit booking strategy when the market hits an all-time high?
They don't have one.
Nor should they.
Really?
Yeah. The Varsity Framework explicitly states that SIP investors shouldn't even get worked up when markets correct violently or reach dizzying all-time highs. If you are an SIP investor, your entire mathematical edge in the market relies on ignoring market timing. Let's dig into the why of that. Why does ignoring the market actually give them an edge? It sounds counterintuitive.
It comes down to the mechanics of rupee cost averaging, or dollar cost averaging.
Okay, walk us through it.
Imagine you are investing $100 every month. In month 1, the market is high. A share costs $10, so you buy 10 shares.
Simple enough.
In month 2, the market crashes terrifically. The share price plummets to $5. A timing-based investor would panic and sell, but the SEP investor mindlessly puts in their $100.
Right.
Because the price is now $5, their $100 buys 20 shares.
So they accumulated twice as many assets precisely because the market crashed.
Exactly. Now they own 30 shares for a total investment of $200. Their average cost per share drops to $6.66.
Okay.
When the market eventually recovers to just $8, it doesn't even have to reach the original $10. They're already in a state of massive profit.
Oh, that's brilliant.
If you start booking profits and pulling money out, you disrupt this mathematical averaging engine. Your job is to continue averaging in until you hit your specific financial goal, like retirement. Do not worry about profit booking based on market levels.
That is incredibly freeing for the passive investor. Now let's look at persona number 2. The equity long-term investor.
Correct.
This is the person doing the heavy lifting. They are picking individual stocks.
Right. And the fundamental assumption for persona number 2 is that you bought that specific stock based on a heavily researched specific thesis.
You didn't just guess.
No. You didn't buy it because someone on television told you to. You bought it because the company has incredibly strong profit after tax or peaky margins. Or maybe they have a stellar return on equity. Or a visionary management team expanding into a new sector.
So if they aren't looking at the chart, when do they finally sell?
You only sell when that fundamental thesis breaks. You do not sell simply because the broader market is dipping or because the stock has gone up 50% and you feel rich.
Give us an example of a thesis breaking.
Let's say you bought a company specifically because it consistently delivers 20% profit margins in a highly competitive industry.
Okay.
Then, over the next year, you read the quarterly reports, and those margins compress to 10% for 3 consecutive quarters due to poor management decisions.
So the business is failing its own standard.
Right. Your thesis is officially broken. The reason you bought the asset no longer exists. That is when you push the sell button. You sell based on the business reality, not the wiggles on the chart.
Got it. It's about the business, not the ticker.
Mm-hmm.
Now we shift gears completely to the active side of the market. Persona number 3. The equity positional or swing trader.
This persona operates in a completely different universe.
Oh, yeah.
A swing trader holds a stock for a few weeks or maybe a few months. They didn't buy the stock because of the ROE or the management team or the 10-year growth plan. They bought it because of a specific chart pattern, a breakout, or sheer price momentum.
They're surfing the wave.
Exactly. Because their holding period is so short, their profit and loss statement is highly, violently sensitive to daily price movements.
So they absolutely cannot afford to just buy and hold through a 20% correction like the SIP investor can. It would destroy their capital base.
Exactly. If you are a swing trader, you must review your stop losses daily. When momentum shifts or when major support levels break, you must act quickly and ruthlessly to book profits or cut losses.
No emotional attachment.
None. Your loyalty is entirely to the price trend, not the company's fundamentals. If the trend breaks, you exit, period.
And taking that need for speed a step further, we have persona number 4, the positional derivatives trader.
This is the swing trader on absolute steroids.
Yeah, this sounds dangerous.
They are trading futures and options. They're using massive leverage, which
Yeah.
means they might control $100,000 worth of stock with only $10,000 of actual capital.
Oh, wow.
Because of that leverage, a tiny 2% move against them in the stock price creates a massive, potentially account-wiping swing in their capital.
So if momentum slows down for them, it's not just a minor dip on a chart, it's a margin call waiting to happen.
Precisely. The Varsity framework notes that these derivative traders must use technical tools like moving averages to constantly gauge momentum. The very second that momentum shows signs of slowing or stalling, they must be exceptionally quick to book profits. Leverage demands ruthlessness. You cannot hope, you can only execute.
And finally, the most extreme end of the spectrum, persona number 5, the day trader.
They are bound entirely by the design of the daily market session. They open their positions in the morning and they close every single one of them before the closing bell rings.
So profit booking for a day trader isn't a philosophical debate about compounding. It's a structural requirement of their strategy. They must book profits or take losses every single day, no matter what.
The fascinating takeaway from reviewing these 5 distinct personas is realizing exactly where and why retail investors usually fail.
It's not because they're bad at math.
No, they don't get slaughtered in the market because they lack intelligence or even because they pick the wrong stocks. They get slaughtered because they suffer from a financial split personality.
Oh, I know exactly what you're talking about. I have been guilty of this so many times. Break down how this split personality ruins portfolios.
A retail investor will log into their account and buy a stock acting as persona number 3, a short-term momentum swing trader.
They just want a quick buck.
Right. They buy it simply because the line on the chart went up 3 days in a row, it's trending on social media, and they want to make a quick 10% in 2 weeks to pay for vacation.
Sounds familiar.
But then reality hits. The stock drops 15%. Instead of honoring their stop loss and acting like the trader they set out to be, they suddenly miraculously morph into persona number 2.
The long-term investor.
Yes. They pretend to be an equity long-term investor. They tell themselves, well, I read it's a good company with strong fundamentals. I'll just hold it for the long run. It will come back.
They completely change their core identity and their strategy just to avoid the emotional pain of realizing a loss.
And the reverse is equally damaging.
Echo.
They will spend weeks researching a phenomenal compounding company. They buy it with the pure intention of acting as persona number 2, holding it for 10 years to build retirement wealth.
Okay.
But then the company releases a great earnings report and the stock pops 40% in a single month. Suddenly, the temptation is too great. They turn into a short-term swing trader and sell it to lock in the quick gain, completely abandoning their 10-year thesis.
So they shoot themselves in the foot both ways.
Exactly. You have to know who you are before you enter the trade, and you have to aggressively stick to the script of your persona.
Okay, let's say I am listening to this, I've done my soul searching, and I identify strongly as persona number 2. I am an equity long-term investor. I do my fundamental research.
Okay.
And you have just spent the last 20 minutes telling me I shouldn't look at my percentage gains to decide when to sell. I shouldn't sell just because I'm up 100%. If I'm supposed to completely ignore the price tag and the percentage return, what exact metric am I supposed to be looking at to know if the market is getting too frothy? How do I know when my asset is overvalued?
Answering that requires a complete fundamental paradigm shift in how you view the stock market. You have to stop looking at the price of a stock and start looking at the valuation of the business.
Price versus valuation. Let's spend some time breaking that down because I think 90% of people use those words completely interchangeably.
They do, and treating price and valuation as the same thing is one of the most costly mistakes an investor can make.
Okay, so what is the difference?
Price is simply what you have to pay for one single share of the company today. That's it. Valuation, on the other hand, is what that entire company is actually worth relative to the actual cold, hard cash it earns.
Okay.
The most common, universally understood metric for this is the price-to-earnings ratio, or PE ratio.
The PE ratio. Okay, let's ground this abstract concept with a real mathematical example from the Shankar Nath source, because this example made the difference between price and valuation click for me perfectly.
It's a great example.
Let's look at Apollo Tires.
Walk us through the hypothetical timeline.
Let's say you bought shares of Apollo Tires a year ago, and the price on the screen was Rs 312 per share.
Okay.
A year passes. Today, you open your app, and the price has risen to Rs 415.
Which is a very healthy, market-beating 33% profit in a single year.
Exactly. Your brain immediately fires off those dopamine receptors. It says 33% in a year. That is amazing. I am a genius. I should sell right now and lock in that profit before it disappears.
The very natural reaction.
It is. But if you stop looking at the price and look under the hood at the valuation, a completely different, counterintuitive story emerges.
Let's hear it.
When you bought the stock a year ago at RS 312, the company's PE ratio was 28.1. Simply put, that means you were willing to pay 28 times the company's current earnings just to own the stock.
Right.
But today, even though the price on the screen has gone all the way up to RS 415, the PE ratio has actually dropped to 16.6.
This is where the paradigm shift happens.
Yeah.
Most people cannot fathom this. How can the price of an asset go up 33%? But the valuation, the actual cost relative to its worth, go down so drastically.
It seems like magic.
It does, but the answer is the engine of compounding. The company's underlying earnings, their actual profits as an operating business, grew significantly faster over that year than the stock price did.
I was trying to explain this to a friend, and I used this analogy.
Oh, I like analogies.
Imagine you bought a house 5 years ago for $300,000. It was a stretch, but you afforded it. 5 years later, the real estate market booms, and the market value of your house doubles to $600,000.
Okay, so you're feeling pretty good.
Right.
Yeah.
But your immediate emotional instinct might be to sell it. It feels too expensive to own. You feel like you're sitting on a massive bubble that is about to pop.
Sure.
But what if, in those same 5 years, your personal salary didn't just double? What if it tripled?
Yeah. Okay.
Suddenly, even though the house is technically worth twice as much on paper, it is actually vastly easier for you to afford the property taxes, the mortgage, and the upkeep. The house has become cheaper to hold relative to your income.
That is a phenomenal analogy. For a publicly traded company, its earnings, its net income, is its salary. If the earnings are exploding upward, a rising stock price isn't a bubble. It is completely justified by the math.
It's just reflecting reality.
Exactly. In the Apollo Tires example, the asset actually got cheaper relative to its earnings. If you panic and sell an earnings compounder like Apollo Tires simply because the line on the chart went up 33%, you are committing a critical, wealth-destroying error. You are pricing yourself out of a fantastic, highly affordable situation just because you got spooked by a bigger number.
Prime Investor offers another staggering long-term example of this with Coromandel International.
Let's look at the historical numbers there, because they prove this point over a much longer time horizon. Say you bought Coromandel International 5 years ago at an adjusted price of RS 190. Over the next 5 years, the company performs beautifully, and the stock price skyrockets to RS 770.
That is a quadruple, a 300% return. Again, your brain is screaming at you to sell. You feel like you've won the lottery.
But look at the PE ratio. Look at the valuation. 5 years ago, when you bought it at RS 190, the PE ratio was 17x. Today, at RS 770, the PE ratio is exactly the same. It is still 17x.
How is that mathematically possible? The price quadrupled.
It is possible because the earnings per share, the EPS, also quadrupled in lockstep. The earnings grew steadily from RS 11 5 years ago to RS 46 today.
So the business just kept pace.
The business simply became 4 times more profitable, producing 4 times as much cash, so the stock naturally became 4 times more valuable. The valuation didn't stretch, it didn't enter bubble territory, it remained perfectly historically consistent. This is the very definition of an earnings compounder. You absolutely should not be exiting this stock in a hurry just because you made massive absolute returns. You only hit the sell button when the PE ratio stretches so far beyond its historical averages or so far beyond its industry peer comparisons that the current price is no longer supported by financial reality.
Okay, so the foundation is set. We do not sell our compounders. We train ourselves to ignore the absolute percentage gains flashing on our screens. We focus entirely on valuation.
Exactly.
But let's bring this down to earth and get highly practical. When do we actually push the sell button for long-term wealth? Because clearly, we can't just hold every single asset forever. If the market is at a dizzying all-time high, how do we systematically, unemotionally take money off the table without ruining our carefully constructed portfolio?
We do it in 2 specific scenarios. When the portfolio loses its structural balance, or when the underlying fundamentals of the things we own begin to rot.
Okay, let's tackle the balance issue first.
This framework comes directly from the ET Now discussion with mutual fund expert Vishwajit Parashar, and it aligns seamlessly with Shankar Nath's advice. It is the concept of strategic asset allocation.
Strategic asset allocation. It sounds like something a Wall Street wealth manager charges 2% a year to do, but it is actually beautifully, elegantly simple to do yourself.
It really is, and it is the ultimate antidote to human greed and fear. Before you invest a single dime into the market, you must define your allocation based on your personal risk profile, your age, and your financial goals.
Give us an example.
For example, you sit down and decide your ideal portfolio should be 50% equity, meaning stocks, 40% debt like bonds or fixed deposits, and 10% gold. That is your anchor. That is your blueprint.
Right, so you set that blueprint up, you buy the assets, and it's running perfectly.
Yes.
But then we enter a massive 4-year bull run in the global stock market. Your equities double in value because the market is soaring, while your debt grows slowly and steadily at 6%, and your gold stays relatively flat.
Right, which happens all the time.
Suddenly, you look at your portfolio pie chart, and it is no longer 50, 40, 10. Because the stocks grew so rapidly, they now dominate the pie. Your portfolio has drifted to 70% equity, 20% debt, and 10% gold.
And this is exactly the moment when the market anxiety hits you. You feel nervous because you intuitively know you are now carrying significantly more risk than you originally planned.
Right, you're top heavy.
Exactly.
Yeah.
If the stock market crashes tomorrow, 70% of your total wealth is exposed to the carnage, not the 50% you were comfortable with.
Okay.
So what is the profit booking strategy?
What is it?
It is entirely mechanical. You do not try to read the tea leaves. You do not try to guess if the market has peaked. You simply look at your allocation blueprint.
You look at the math, and the math says you are 20% overweight in equities.
Precisely. So you sell that 20% excess equity. You ruthlessly book those profits, and you immediately move that freed up capital into the underperforming asset classes. In this case, you buy more debt to bring that slice of the pie back up to 40%.
So by strictly following this mathematical rebalancing rule, you are automatically, almost unconsciously forcing yourself to buy low and sell high without ever having to predict the future.
It's built right in.
You are trimming the asset that just surged and is likely expensive, and you are buying the asset that has been ignored and is relatively cheap.
It completely removes human emotion from the equation. It guarantees 90% of your portfolio's long-term success because greed and fear no longer drive the bus, the spreadsheet does.
But wait, let me push back on this because I can hear the critics and the stock pickers screaming right now.
Bring it on.
Warren Buffett has that incredibly famous quote about bad portfolio management. He says people tend to cut the flowers and water the weeds. Isn't rebalancing literally selling my winners, the equities that are soaring and making me rich to fund my losers, the debt or gold that isn't doing much of anything? Isn't that the exact definition of watering the weeds?
This is a crucial, vital distinction to make, and it is where many retail investors deeply misapply Buffett's advice. You have to intellectually separate broad asset classes from individual assets.
Okay, draw that line for us. Explain the difference.
Rebalancing between broad asset classes, like shifting capital from equities as a whole into gold or debt, is deeply healthy because asset classes move in macroeconomic cycles. Equities will invariably have a devastating down cycle, and during that time, debt or gold will provide the stability that prevents you from panic selling.
That makes sense.
When you rebalance asset classes, you aren't watering weeds. You are fortifying the defensive walls of your castle while the sun is still shining.
Right, you're preparing for winter.
Exactly. However, where Buffett's quote absolutely 100% applies is within the equity portion of your portfolio itself. Keeping individual dud stocks, the specific companies that are failing, while selling your compounding winners to fund them is financially toxic. And this leads us directly to the second reason to push the sell button at market highs: weeding the garden.
Yes. The prime investor source goes deep into this concept. An all-time high in the broader market is the absolute perfect excuse to do some brutal spring cleaning.
It really is the best time.
Think about the logic here. We have been in a massive, euphoric 5-year bull market. The saying goes, a rising tide lifts all boats. Even mediocre companies see their stock prices go up in a bull market. So if you look at your portfolio today, amidst all this euphoria and record highs, and you have a stock that is still sitting in the red, you have a massive, glaring problem.
It is a siren blaring in your portfolio. If a specific stock cannot make money during a 5-year raging bull market where money is cheap and everyone is buying, one of two things is undeniably true.
What are they?
Either your initial buy price was so excessively absurdly high that you will mathematically never recover, or the underlying business fundamentals of that company have completely deteriorated since you bought it.
Those are the weeds. You don't hold them hoping they recover. You pull them.
You must ruthlessly cut them. And you must do it before you even consider touching your high-conviction, deeply researched compounding stocks.
How do you separate them?
Shankar-Nath breaks this weeding process down by conviction levels. High conviction bets are the ones you researched for weeks, where you understand the business model inside and out, and the original thesis still holds true. Low conviction bets are the flukes.
Let's be honest about what low conviction bets are. They are the hot tips you got off a random Twitter thread. They are the stock your uncle confidently told you about at a summer barbecue.
Yeah.
They are the company whose business model you couldn't explain to a 5-year-old if your life depended on it, but you bought it anyway because everyone else in your office was buying it and you had a FOMO.
We all have them. If you have gotten lucky and ridden the bull wave on those low conviction stocks, use the liquidity at the all-time high to cash them out. Book the profit on your own ignorance before the market inevitably corrects and punishes you for holding assets you don't understand. And for the ones that are outright loss makers, sell them. Take the hit.
And there is a massive, highly practical bonus value to selling those loss makers, right? The tax angle.
Yes, tax loss harvesting. This is a brilliant professional level strategy.
Let's walk through how it works. Let's say you did your strategic asset allocation rebalancing and you sold some of your equity winners to buy debt. You now owe the government capital gains tax on those profits. It's a drag on your wealth.
Nobody likes paying taxes.
No, but if you simultaneously do your spring cleaning and sell your dud stocks, the weeds, at a loss, the tax code allows you to use those realized capital losses to directly offset the capital gains from your winners.
It's beautiful.
So you are cleaning up your portfolio, drastically improving its fundamental quality, reducing your risk, and the government is essentially giving you a massive tax discount to do it. That is a total win-win for the investor.
It is the absolute hallmark of a mature, professional approach to portfolio management. You turn your mistakes into a tax shield.
Okay, so we have established a really robust, practically bulletproof philosophical framework here. We know what to sell: our excess asset allocation, our low conviction speculative bets, and our fundamental weeds.
Right.
And we know why we are selling: to maintain structural balance and valuation discipline rather than reacting to price. But let's transition out of the philosophy and into the tactical trenches.
Let's do it.
How do we physically execute these exits? Because knowing what to do doesn't stop the panic when you log in on a random Tuesday and see the market drop 2%.
Execution is where the philosophy meets the harsh reality of the market. If you execute poorly, even the most brilliant strategy fails entirely.
Right.
Let's start with a mutual fund investor. You've looked at your spreadsheet, and you've decided you need to reduce your equity allocation from 80% down to 65%. That's a 15% reduction, which could be a massive amount of capital.
Oh, yeah, a huge hunk.
The absolute worst, most destructive thing you can do is log in, select that 15%, and hit sell all on a single Tuesday morning.
Because what if you sell on literally the worst possible day of the month? What if the market drops 3% that morning on fake news? You sell, and it bounces back 4% the very next day. You would be sick to your stomach.
You expose yourself to massive, unnecessary timing risk. To mitigate this, the pros use a systematic withdrawal plan, or SWP.
How does that work?
Think of it as the exact inverse of an SIP. If you are trying to move, say, RS15 lakhs out of equity to rebalance, you do not do it in one giant lump sum. You set up an SWP with your broker to automatically sell RS 2.5 lakhs every month for a 6-month tenure.
So you are phasing out in equal lots over time. You are mathematically averaging your exit price, just like you averaged your entry price when you were building the wealth.
It beautifully smooths out the volatility. More importantly, it completely removes the psychological stress of trying to pick the perfect day to sell, which we know is impossible. Now, that is for mutual funds and passive investors. If we look at the active traders, the swing traders and positional traders we discussed earlier under Persona 3 and 4, their execution tool of choice is different. Angel One highly emphasizes the importance of the trailing stop loss.
Trailing stops. I find these fascinating because they seem like magic when used correctly. Walk us through the mechanics of a trailing stop for someone who might just use standard limit orders.
A standard stop loss is static. It is a fixed price below your entry point where you agree to take a loss and exit. You buy at 100, you set a stop at 90. If it hits 90, you are out.
Simple enough.
But a trailing stop loss is dynamic. It automatically moves up as the price of the asset moves up.
Oh, nice.
Say you buy a stock at 100 and set a trailing stop at 90. The stock goes on a run to 120. Your stop loss doesn't stay at 90. It automatically trails behind the price and moves up to 110. If the stock goes on a massive run to 150, your stop moves up to 140.
So it allows you to aggressively capture those massive multi-month market moves. Because as long as the stock keeps going up, you stay in the trade. You don't tap your upside.
Novice traders constantly book profits way too fast because they desperately want the dopamine hit of a win. They take a 5% profit, feel like a genius, and then watch in horror as the stock goes on a 50% run without them.
It's the worst feeling.
Expert traders use trailing stops to mechanically ride the trend until the market mathematically proves the trend is over by reversing and hitting that trailing level.
That makes a lot of sense.
The real skill is setting the distance of the trail. Angel One advises keeping stops wide enough so you aren't knocked out by normal daily market volatility, but tight enough to rigorously protect your accumulated equity when a real reversal happens.
Okay, so SWPs for the mutual funds, trailing stops for the active trades. But there is one absolute non-negotiable cardinal rule of profit booking that spans across every single source we reviewed today.
There is.
Prime Investor, Shankar Nath, ETS. Now, they all essentially scream this from the mountaintops.
Never sell without a redeployment plan.
Never sell without a redeployment plan. This is so crucial. Let's play out the scenario. Let's say you get nervous, you read a scary headline, you think the market is frothy, so you liquidate a massive chunk of your portfolio.
Okay.
You are now sitting on a giant pile of cash in your brokerage account. What happens next?
Usually, profound regret.
Really?
Yes. Sitting on a pile of cash while trying to perfectly time a re-entry into the market is nearly impossible, even for professionals. If you sell simply because you think a crash is coming, you have now forced yourself to make a second, even harder decision. When exactly do you buy back in?
And as the Prime Investor article rightfully points out, market tops are just as hard to predict as market bottoms.
They are.
If you sold out, waiting for the dust to settle, look at the historical data. Look at the ferocious bounce back from the March 2009 lows after the global financial crisis, or the absolute rocket ship rebound from the March 2020 COVID crash.
Those recoveries were incredibly rapid and violent. If you were sitting in cash, waiting for the perfect safe moment to re-enter, waiting for the economic data to look good again, the market rocketed right past you.
You missed the whole ride.
The market recovers months before the economy does. By the time you finally felt safe enough to buy back in, you were buying assets at prices much, much higher than where you originally sold them. You effectively pay a massive penalty just to sit in cash.
So before your finger ever hovers over the sell button, you must know exactly where those funds are going next. Every dollar needs a job description immediately.
Exactly. Maybe the job is meeting a real-world, tangible financial goal. If you need to pay for a child's university education or a house down payment in the next 6 to 12 months, that is a fantastic, unassailable reason to book profits.
For sure.
Move that money immediately into a fixed deposit or a highly liquid, ultra-safe debt fund, so it's protected from volatility and ready when you need to write the check.
Or maybe the job is purely mechanical rebalancing, like we discussed earlier. The cash moves instantly from the overvalued equity to the undervalued gold. It never sits idle.
Or, if you are tactically reducing your exposure because you genuinely find the broader market historically overvalued, build a highly specific wish list of stocks before you sell.
So have a shopping list ready.
Yes. Write down the companies you have always wanted to own but found too expensive. Do the deep fundamental homework now, calculate their intrinsic value. So when the market inevitably does correct, your cash isn't paralyzed by fear, it is instantly, confidently deployed into high-quality assets at a massive discount.
Give your money a job description before you hire it back to your bank account. I love that framework. Okay, we have covered the high-level philosophy, the deep psychology, the underlying math, and the broad execution strategies.
We've covered a lot.
I want to spend the last segment of this deep dive getting directly into the tactical trenches. We have an incredible set of real-time trading notes from the TradingView community.
These are great.
These are active swing traders showing us exactly how they spot the precise moment to book profits. We aren't going to read a list of charts. Instead, let's group these by the specific lessons they teach us about market mechanics. Let's start with what a structural breakdown actually looks like.
This is a great exercise because it grounds everything we have talked about regarding persona number 3, the swing trader in visual reality. Let's look at the lesson of structural failure using the Go Fashion chart.
Right, so the trader here marks this stock as profit booked. They're out. Why? What did the chart show them that overrode the desire to hold?
It showed them that the fundamental architecture of the trend had collapsed. In technical analysis, a healthy uptrend is defined very simply by a series of higher highs and higher lows.
Okay, staircase going up.
Exactly. The price surges, pulls back slightly, and then surges higher than before. But in Go Fashion, the trader identified a prolonged distribution phase. The stock stopped making higher highs. Instead, it made multiple lower highs.
Oh, that's not good.
The buyers simply couldn't push it up anymore. This is the primary early warning signal of trend exhaustion. Then, the critical moment happened. The price broke decisively below its rising support trend line, and it was followed by sharp, heavy volume selling.
It makes me think of playing Jenga.
Jenga. How so?
Well, while the Jenga tower is being built, it gets higher and higher, and it looks perfectly stable. You feel great. But what the trader saw in Go Fashion was that the critical load-bearing block, that rising support trend line, was just violently pulled out.
Ah, I see.
The structure isn't just going to lean, the whole thing is about to collapse.
That Jenga metaphor is incredibly accurate. The thesis for holding that stock as a swing trade was entirely dependent on its upward trend. Once that trend line broke and the structure failed, the trader didn't sit there and hope it would miraculously bounce back.
They didn't turn into a long-term investor.
They didn't morph into a long-term investor and start reading annual reports. They ruthlessly executed their exit strategy. As they put it in their notes, avoid catching a falling knife. They protected their capital.
That is the ultimate discipline. Now let's look at the second major lesson from these charts: momentum exhaustion and divergence. This one is conceptually fascinating because in these examples, the price was actually still going up, but the traders decided to book partial profits anyway.
It seems backwards.
Why would you ever sell if the price is actively hitting new highs?
Because of a technical concept called divergence, specifically identified using momentum indicators like MACD and RSI.
Okay, I have always found MACD and RSI incredibly intimidating. When you look at them on a screen, they just look like a mess of spaghetti lines moving around at the bottom of the chart.
They do look confusing.
But fundamentally, if I understand it right, they are essentially just measuring the speed of the car, right? Not the direction it's traveling.
That is the perfect way to demystify them. MACD, which stands for Moving Average Convergence Divergence, and RSI, the Relative Strength Index, measure the momentum or the underlying energy of the price move. Let's apply your car analogy to the auto sector chart analysis provided. The price of the auto sector index was pushing higher, hitting the upper boundary of its resistance trend line. The car is still moving forward.
Right.
But if you looked at the spaghetti lines of the NCD and RSI, they were not making new highs. They were actually moving sideways or even sloping slightly downward.
So the car is still physically coasting up the hill, but if you look at the dashboard, the engine is sputtering and the RPMs are dropping, it's running out of gas.
Exactly. When a technical trader sees this, when price makes a higher high, but the momentum indicators make a lower high, it is called bearish divergence.
Bearish divergence.
And when bearish divergence occurs right at a major historical resistance level, it is a glaring neon warning sign. The trader recognized this fading momentum. They didn't panic and short the market, but they used that signal to rationally book partial profits.
They took some chips off the table.
They took some risk off the table, planning to re-enter later when the price naturally exhausted itself and corrected back down to a more stable support level like its 50-day moving average.
It's a surgical strike. We see the same exhaustion lesson applied to the small cap 100 index. The trader notes that the index had gone on a 125% run since April 2023. A monster rally.
Huge rally.
But they didn't sell just because 125% felt like a big number. They saw the volume and price action displaying that same exhaustion.
As the trader wisely noted, any bull run stops at some time. Just be at the door before the party gets over.
I love that quote.
For a positional trader, when you see momentum fading after a parabolic 125% run, the mathematical risk-to-reward ratio completely flips against you. The downside risk of a sudden, violent 20% correction vastly outweighs the potential for squeezing out another measly 5% gain. The technical signals tell you it's time to pause and protect.
What I love about diving into these specific tactical lessons is the unifying theme. None of these active traders are just guessing.
They aren't guessing at all.
They aren't waking up, looking at their account balance and saying, well, I feel like I've made enough money today, I'll hit sell. They are acting on distinct, unemotional, mathematical signals-failing Jenga structures, sputtering engines shown by divergence, and broken trend lines.
And take that a step further, notice how perfectly this tactical approach aligns with our earlier philosophical discussion about the market personas.
Oh, how so?
If you are a positional trader holding Go fashion, you must respect that Jenga tower collapsing and sell. That is your sole job. But if you are a 20-year SIP investor or a long-term fundamental investor who bought Go fashion because you deeply fundamentally believe in their 10-year nationwide retail expansion plan,
You just ignore it.
you can probably ignore the MACD divert and the trendline breaks entirely.
Because to the fundamental investor, that chart is just noise. It's a short-term weather pattern, and they're playing the long-term climate.
The technical signals are vital tools, but they're only useful if they are relevant to the specific game you are actively playing.
This has been an incredibly dense, multi-layered, and eye-opening journey. We have covered a massive amount of ground. Let's do a comprehensive recap of the core pillars we've built here today to give you, the listener, a concrete, actionable playbook for your portfolio moving forward.
Pillar number 1, you must know your persona. Are you an automated SIP investor, a deep research fundamental holder, or a ruthless swing trader? Define your core identity in the market before you ever try to define your exit strategy.
Pillar number 2, respect business valuations over absolute percentage gains. Do not accidentally chop down your compounding apple tree by selling an earnings compounder just because the price doubled. Look at the PE ratio. Make sure the actual business isn't outgrowing the price tag.
Pillar number 3, rebalance systematically based on your strategic asset allocation. When your planned 50% equity naturally drifts to 70% equity during a bull run, trim it back. This mechanism forces you to consistently sell high and buy low without any emotional interference.
Pillar number 4, phase out your exits. If you need to move large sums of capital, use a systematic withdrawal plan over several months. Do not expose yourself to massive timing risks by trying to pick the perfect day to sell a lump sum.
Pillar number 5, cut your fundamental weeds. Use the liquidity and euphoria of an all-time high to ruthlessly clean your portfolio. Sell your loss makers and your low-conviction speculative tips. Do not cut your compounding flowers to water your dying weeds.
And finally, pillar number 6, never ever hit the sell button without knowing exactly where those funds are going next. Have a strict redeployment plan ready, whether it is moving to debt for safety, buying gold, funding a real-world financial goal, or loading up a research stock wish list.
As an investor, you hold the ultimate power over your portfolio. The market will constantly, relentlessly try to dictate your actions through waves of euphoria and valleys of panic.
It really will.
The numbers will flash green and red to manipulate you. Do not let those flashing lights dictate your clicks. Make your profit booking a boring, highly strategic, and immensely profitable business decision based on math, structure, and discipline.
Make it boring to make it profitable. I think that should be on a plaque above every investor's desk. To close us out today, we want to leave you with a final, provocative thought. It is a mental exercise that you can use to rigorously stress test your own portfolio right now, the exact second this deep dive ends.
I want you to imagine a scenario.
Yeah.
Imagine that you were forced by some absolute external mandate to liquidate your entire stock portfolio tomorrow morning. Every single share you own is sold at the market open, and your account is turned entirely into cold, hard cash.
Okay, picture that.
Now imagine you are required to take all of that cash and buy back into the market on Monday morning.
Here is the critical, revealing question. How much of your current portfolio, the specific stocks and funds you currently own today, would actually make the cut? If you had to consciously, deliberately choose to buy them again at their current all-time high prices, which ones would you eagerly repurchase because you believe in their future, and which ones would you quietly, secretly leave behind?
It is a brutal test of conviction. Whatever you wouldn't eagerly buy back on Monday morning is exactly what you should be booking profits on today.
Because paper wealth isn't real until you secure it. Don't leave your monopoly money sitting on the board waiting for a market correction to take it back. Be strategic, know your persona, clean your Jenga tower, and secure your financial future. Until next time, keep diving deep.